Hi, and welcome to Macro Windsor. We talk macro, trying to make sense of markets that, well, really don't make any sense. But more importantly, we answer your questions so we can become better investors. And did we not nail that CPI report? Woo! We got it. We nailed it. And then what did we get today? Producer price index, deflationary. We nailed it. We did it. Thank you. You and I, we did it together. You should be as happy as I am. I hope you were celebrating that on Tuesday morning when you saw that print came out. I hope you were looking, because we nailed it. And I couldn't have done it without you. Because, you know, when you go and put your thesis online, out for the whole world to see, and you put all of your data and research out there for all of the world to see, and you say, come to my door and ask any question that you want, as long as it's not trading advice. See, I invite you to challenge my thesis, my view, find what I missed. And together we did it. And because of you, I am a better investor, a better money manager. And I hope because of me, you are a better investor as well. Wow, I was so excited. Let's look at the charts because we just hit this thing perfectly. Look, crude oil signaled right exactly where consumer prices were going. And what is that telling us? That guess what? Consumer prices headed lower. Crude oil probably also headed lower as well. How about on a year-over-year basis? This is a chart I haven't shown you before. I took that same crude oil and I put it on a year-over-year basis. It's telling us that consumer prices are potentially headed to -2 below where they were during the great financial crisis. See, I don't think oil's out of the woods yet. I know a lot of people do. I'm not one of those. Now, I saved a couple charts as backup in case I wasn't going to worry about being wrong. I mean, look, truthfully, I went to bed Monday night with that kind of nervous anticipation. I mean, if you're not nervous, you're not in the game. You know, and what do I mean by nervous anticipation? Maybe like the first date, you know, you're going out with someone and you're like, man, I hope it goes good, you know, and you're just excited that you want it to go well. And I knew we had this thing, and 5:30, pulled up my phone and bam, I love it. All right, so here's another chart that shows quantitative easing against the consumer price index. I don't remember if I showed this to you, but anyways, you can see when QE1 hit, consumer prices went down. Now QE2, we saw consumer prices went up, and this is where a lot of people get their thesis that the QE causes a rise in consumer prices. It doesn't. What happened is the stock market bottomed here somewhere in early 2009, and then yields bottomed a couple months after. And what happened right here when the Fed went to do QE2 is yields were rolling over because of QE. Because remember, QE causes interest rates to go down, and the consumer price index was really just lagging it. And you can see in QE3 right here, consumer prices flattened out and went down. And it wasn't until they stopped doing QE that, wow, lo and behold, we get inflation. And at the end, we get this massive surge in quantitative easing. Guess where you think consumer prices are going? They're going down. Now, I also took that same QE chart in blue. Again, that is the total balances maintained at Federal Reserve banks. That is QE in blue against GDP. And you can see when the whir of QE turns on, GDP goes down. Now, granted, there was a recession there, but look, QE2, GDP growth down. QE3, all it did was deflate what was the strongest growth of this last 10 years or since the great financial crisis. This should have been more growth, but the Fed actually slowed it down so much that the economy could never recover, even with a corporate tax cut and a personal tax cut. They couldn't get it. And then now you can see, look, whir of QE, and where do you think the GDP growth is headed, in addition to the fact that the economy is slowing down due to the coronavirus effects? It's obvious what is coming. But how about this? We predicted that real yields were going to go up. Boom, there they did. Real yields are rising. Let's take that over to the PowerPoints, the Fisher equation, and what do we see here? Minus 0.1% net loss. This was the other day, 1.4% on the 30-year, minus 1.5% on a year-over-year basis. Consumer price index, negative 0.1, meaning bonds were a losing deal. No one wanted to own them. They're short bonds, short bonds, short bonds. Now you have 1.4%, a little bit less on the 30-year, minus 0.3%. CPI on a year-over-year basis. Now you have a positive carry on the bond market. And why do you think money managers are going to start buying treasuries? Because they can make free money here. They now can make money buying bonds against a market that is very, very, very short. Now, why are sellers still pushing back? Because they're deep in their trades. They're really very deep. And sometimes in the market, you can take whatever the facts are and maybe you push things in the other direction and you can get everyone to believe. The problem is it's not working. So here we see the bond market has rallied in the face of the Fed cutting back on his QE a bit, which everyone said would send yields spiking. On the largest week of Treasury issuance, I believe, in history, everyone said that would cause interest rates to go up. They went down. And on the fact that deflation is happening. I mean, we have the largest, I think, 1 month drop in the consumer price index. The producer price index is now showing deflation. Everyone said that can't happen, and it did. Now, how do you fix this problem from the Fed's perspective? So you have yields, which you control the short end, not the long end, and you have inflation. Now, Fed does not set consumer prices. They have no control over that. Technically, if they raised rates, consumer prices would rise, but that's not going to happen right now. So how do you fix this and turn this into a negative number again? Because what the Fed wants to do is they want to inflate debt away. And what this is making debt expensive. Now, how's that happening? Because the drop in consumer prices is really bad news for companies. And I saw a report from small businesses this morning that said they're lowering their prices too. And what happens when a business lowers prices? Well, their revenue and their profits drop. But what doesn't drop with it? Their debt. Their debt service does not fall. So you have falling consumer prices, debt's up here. So then the market was like, all right, well, okay, we can get past the consumer pricing. As long as producer prices go up, that will tell us inflation is coming, because it just means that businesses are lowering their prices to bring back demand, but really producer prices are what matter. And we got a deflationary print. And what does that tell us? That input prices are falling, output prices are falling, and that is bad news in a debt-based economy. Because again, producer prices go down, what is also going down? Revenue and profits. As everyone claims, the stock market is going to go, oh, so much higher because it knows something that no one else does. Well, what it hasn't figured out is we're in a deflationary environment. And as a result, the debt is not going to go down. In fact, we're in the most indebted economy in the history of the country and in the world and of any economic cycle. It's going to be painful. Deflation is not what anybody, well, I'm okay with it, but the Fed is not. You know, if you plan on this and you've saved money and you're invested right, deflation is the greatest thing that can happen. If you don't have any money and you're heavily in debt, deflation is the worst thing that can happen. And the Fed hates deflation. But anyway, so what can the Fed do here? Can't fix this, but you can certainly bring yields down. And if you can bring yields down, you can get this number to post negative. So what do we know is going to happen? Boom, the Fed's going to have to keep lowering rates. They're going to have to keep doing quantitative easing. They're going to have to keep pushing this thing down, even as investors fight against it. Even as investors fight against it. They're on the wrong side of the market. I mean, we beat the hedge funds, the alleged smartest guys in the room. We beat them. We beat everybody. We're the smart money. Isn't that so cool? I love it. I love it. I really hope you're celebrating. We should have a party to celebrate, but we can't do that. But we should, but we can't. So anyways, that is all good stuff that's going on for us. Not great for the economy, but from a positioning standpoint, you know, what really comes next? Well, from a macro view, I now know I'm positioned correctly. I know my clients are all good, and this plays out over the next, 1, 2, 3, 4 months, 5 maybe. It took 4 months really in great financial crisis for this to play out. I don't think it takes that long because the Fed is doing a lot more QE, but it does tell me deflation, yields are headed down, and it also tells me that stock prices are headed lower. And then people are like, well, wait a minute, I thought that wasn't how that worked. Well, once again, people believe that negative yields and low interest rates good for stocks. I can guarantee you they have never charted the two on one page together, because it's very clear in blue when 3-month Treasury yields go down, well, then stock prices are soon to follow. So you can see stock prices are up here. Who says that the bond market doesn't know anything? The bond market leads the stock market lower on average by 3 months. It tells you everything you need to know. So the smartest people in the room apparently do not know how to make the simplest chart. How about that? So I look at my thesis and say, okay, I'm good now. The data has validated. There's no chance that we're going to see inflation. It's going to continue to be, the CPI index is going to go down. The PPI index is going to continue to deflate. So what do I need to do now as a money manager? I need to look at my exit points. I need to review them. Remember, you always have to have two. If you miss the first one, you got to have your backup. So I've reviewed my primary exit point. I have no intention of missing it, but I have a backup in the off chance that I don't make it. And then I also want to look at where I'm going to go next from an investment standpoint. And I don't have one, I have multiple. So is it going to be stocks? Is it going to be high yield bonds or high risk bonds? Is it going to be commodities, precious metals, emerging markets, foreign stocks, whatever it is? And it should have at least two, ideally three, because sometimes as investors, we're really focused because our position, is really bullish. So we're whatever it is, it's going up, and we're very excited. And then what happens is our next opportunity comes. Maybe it's in stocks or something, and that goes right by because we're just like, man, we're doing really good. And then you go, well, wait a minute, I missed my exit. I wanted to be over there now, and that path. Well, is there a second place you can be, or a third? Because sometimes things don't play out exactly as you want them to. So you always have to have your next place in mind. So I spent my morning kind of reviewing that, just solidifying what I knew, where I wanted to go, and when I wanted to be there, and how I was going to get there. So that's kind of the next step in being a macro investor, is figuring out where to go next. Now, we had some very interesting economic news today, and Fed Chair Powell came out, and the market was hoping he was talking about negative interest rates. And this is one of those things where, as you just saw on the chart, is the market thinks it wants something until it realizes it doesn't. And even as President Trump has been saying, he wanted lower interest rates. I kept saying, no, you don't. You don't. You really don't. You don't know that you don't. But there's going to be a point where you're like, why did that not work? You don't want lower interest rates because it brings stock prices down. I mean, we know that yields go down, and we know when yields go down that stocks soon to fall. This is the relationship that we need to focus on right now. So the market wanted Fed Chair Powell to come out and announce a negative federal funds rate, or just the potential that we could. I don't think he's the right guy to do it. I don't think he wants to be the Fed chair that takes the funds rate negative. I think he's going to have to. I don't think he wants to. I don't think he's the right guy. I guarantee you that if he does end up being that one, he's going to confer with former Fed's chair, Yellen, Bernanke, Greenspan, anybody he can talk to. Anybody, because there's no way he wants to be the guy that potentially blows up the global economy because he did something he shouldn't do. There are people that think you can have a negative federal funds rate without a problem. There are people who believe that it is a monster of a problem, that you can't do that. The reality is we don't know. But I have a hunch he's going to be forced into it, because he said something in his speech this morning, and I'm just going to go to the end of it or the end of what he said. He said that sometimes a liquidity problem can turn into a solvency problem. Now, what does he mean by that? Well, he identified the first part correctly. We do have a liquidity problem. There is a global dollar shortage. So he is absolutely correct. So when he says liquidity, he's referring to the world. Well, he's not directly referring to world dollar liquidity, but that's what he means. I don't know if the Fed even knows what world dollar liquidity is, but he realizes there's a shortage of dollars. Now, he has a limited number of policy tools to use, so he's using quantitative easing to effectively, quote unquote, create dollars. Now, he's swapping, again, bonds for dollars, but where are those dollars going? They're getting locked up in the Federal Reserve Bank. That's all he can do. So he is correct. There is a liquidity problem. Now, he says that can turn into a solvency problem. Now, what does that mean? Well, let's say I told you I was insolvent. What would you think that means? Well, it would mean I can't pay my debts. Now, remember, we've been told we can never have a great financial crisis, and we can never have a banking crisis. Everything's cool. And I've been said, no, we can. They're wrong. And why are they wrong? Because a liquidity problem does turn into a solvency problem. And what that means is if you don't fix world dollar liquidity fast enough, if you don't get enough dollars out back into the global economy circulating, creating growth, creating inflation, What happens is you get deflation. And we got deflation effectively in the producer price index, and we'll probably see deflation in the next print, the consumer price index. And what that means is that there is clearly not enough money to pay the debts, and that leads to bankruptcies. And that brings the whole banking system down when people default. And if you look at from an economic standpoint, the situation that we're going through is not good. I mean, you have multiple things happening at once, and the Fed is powerless to do something. So he is right. If this doesn't get fixed, things are going to get worse. And again, all he can do is lower short-term interest rates. He can't make people spend. He can't put dollars in the global economy. He doesn't have the ability to. The Fed cannot create money, cannot print money. So he's got a big problem. But I still think he's the one that takes the funds rate negative. I think the collapse, or I think when the stock market finally breaks down, he's going to have no choice. He'll be the one that does it, but I don't think he's going to want to. That's my opinion. And we're starting to hear about problems with the Congress not wanting to pass more stimulus, and you're hearing some people that do and some people that don't. I don't think we're going to get much of it. Is that a mistake? Look, from a personal standpoint, that's one thing. Let's focus on the economic standpoint. The economic standpoint is we've issued a massive amount of debt, a massive amount. And we're technically not in recession because I know, it's like, how are we not in recession? We're not in a recession until the wealthy people lose their money because the stock market goes down. That's the bottom line. And if you don't believe me, the top 10% in wealth, those who are in the top 10% in this country by household wealth, own 90% of the market. That's who the Fed really cares about. As long as they don't lose their money, it doesn't really matter. Once the stock market falls, which it will, because we've looked at that, we know what's going to happen, then they'll be forced to act. More quantitative easing, more deflation, potentially lower negative federal funds rate. I don't know how they're going to avoid it, but I think they're going to do it. I think they're going to have to do it. And we talked about, last week or so, that something I saw said that businesses have 6 months before they fail, and I said, economically, I don't believe that number. Well, there's been 2 separate surveys that came out last week or earlier this week, and they said that 40% of all small businesses have about 2 weeks worth of money left. If you're wondering why there's a push to get states reopened, I can tell you, when a small business fails, it doesn't usually come back. It's a lot of work to bring that business back, takes money to bring it back, and they need people to go back to work. I realize that it's probably not the smart move, maybe it's not the safest move. I'm just telling you economically why they need to do it, because the more debt the government issues, the bigger the problem is. When we do actually see the stock market go down, they're running out of ammunition to actually deal with it. You got to think, when was the last time in the history of our country where we had massively high unemployment and deflation? Do you know when that was? Wasn't the great financial crisis, wasn't the dot-com bubble, it was the Great Depression. And we had, I was going to say JFK, I was wrong, and not Hoover, because he wouldn't do it. Now it slips my mind, and I was just kind of, I know who it is, Roosevelt. And what he did is he did a bunch of deficit spending to have work projects, and that didn't actually create inflation. We still had deflation. The final solution was devaluing the dollar. I don't know how we're going to do that, but that's probably what's coming. I think we have a massive problem coming that neither the Fed nor the federal government has the ability, either monetarily or fiscally, to fix, and that's a challenge. And so we also start hearing in the news something about retaliatory efforts against China. And you probably heard that, I believe it's a TRS program that has about $40 billion invested in China, and President Trump wants to effectively move that money back to the U.S. as a penalty against China for not doing whatever it is we're going to ask them to do or have asked them to do. I really don't focus on the things that I know China is not going to do. But the question is that really a penalty, or why are we doing it? It's not the reason you think. Because if we can shift $40 billion of foreign-owned stock money into $40 billion of U.S. equities, that's the purpose, is to keep the stock market up as long as possible. That's the ultimate goal. Now, of course, it'll have all these people in the TRS program that were at some point diversified, now owning a bunch of U.S. stocks near the peak, and that won't go well for them. But who knows how that's going to play out. But keep in mind, that is the real issue. It's get more money into U.S. stocks. If you don't think that's what's going on, that is the real message here. So let's take a look at some charts and see what's kind of going on there, and then we'll get to your questions. I've got a bunch of them to talk about. So let's take a look at the S&P 500. Looks like it's double topping here. After this, we know this thing's going to head lower. The market's fighting against it. We did see some late day buying. If we look from volume, oh, just see a pickup in volume here today. And we noticed this whole rally has been on declining volume, which is a lack of interest. You know, when there's fewer people at the auction bidding, that doesn't tell you there's demand. But usually when you start to see things go down, you should start to see a pickup in volume. So this could be a signal, much like right here, that we are at the beginning of a down move. How about from Treasury yields? We did see today 30-year yields broke through their 50-day moving average, close below it. Now, I'm not a big proponent of moving averages. I know a lot of people like to trade them. If you do that, that's fine. It's a lagging indicator. But what moving averages do for most investors is just confirm the trend. So this was a consolidation pattern, which I said it was. I said it will peak around 1.4 again. It did. It will head lower. It will retest 1.2% here at some point, maybe this week, maybe next week. I don't know. And if it breaks through here, now you've got to run at yields going to zero. And what the 50-day moving average here is telling investors is that, look, the trend is still lower. In order for the 50-day to confirm that things are going higher, this consolidation pattern would need to turn into a bottoming pattern and go longer, let the 50-day flatten and move up. But at the moment, it tells us this is the trend. Now, I like to look at TLT, not because I'm giving you investment advice, because I'm not, because it gives me a more granular look at the long-term bond space. And TLT is a 20-plus year Treasury bond fund. And we can see, again, it closed over its 50-day moving average now for the second day in a row, and it's telling us that the trend is higher. Now, if we zoom in, we can see kind of what happened today. And it got up to this dotted purple line is where 1.3% yields are, and it got really close to that, and then it found sellers. But notice every time it gets near 1.3 recently, you've seen sellers in the overnight market, sellers in the U.S. market, sellers in the overnight market, sellers in the U.S. market, sellers in the overnight market. And what we are learning here from a technical standpoint is that sellers are happy to sell at 1.3. And the only question becomes is when they run out of ammunition. You know, you've seen some very heavy selling here, very heavy selling here. So the question is, are they still have a lot left to sell? Are they going to drive it back down? Or are they running low on their desire to sell and that they're going to get squeezed out? So we're going to look from a bullish standpoint, at least from the opposite of 30-year yields, to support my view that we're going to see lower Treasury yields, that I want to see this break through 1.3 up and move up here and squeeze these short sellers, start squeezing them out. They're still not done trying, but it doesn't mean the show is over by far. It just means they're not done giving up at that level yet. All right, let's take a look at some of your questions. It says, you mentioned the fact that people think quantitative easing is good for the market. I think it is good psychologically. People believe quantitative easing causes stock prices to go up. That is inaccurate. What causes stock prices to go up is people buying stocks and then more people buying stocks. Quantitative easing does not take any transactions in the stock market. It does none of that, but it's not what people believe. And that psychology is what's boosting the stock market. Yes, because people believe in it. When people believe and go buy, it's a self-fulfilling prophecy. People are still buying despite the horrible things happening in our economy. Yep, they sure are. Can this continue to happen in perpetuity? Nope. And the reason it can't is people will eventually run out of money. Or is a market that doesn't make any sense going to start making sense? Don't worry, it will make sense. The bond market is telling us, the data is telling us that deflation is coming, and stock prices do not do well in deflation because, again, you're going to find out in the next quarter earnings that, well, hey, That debt that we took on to buy all of our stock back, well, yeah, now we gotta pay it, and we're gonna pay it with less revenue and less profits. Yeah, it's not how it doesn't work out too well. It's not gonna hold up long term. Next question. I understand lay people being irrational and exuberant, but why are institutions planning ahead with their bullish mentality as well? Simply because in the investment world, you have to play chase, and money managers play chase because, if my fund underperforms your fund and they're similar funds, people are going to move their money. If you ask people, should you invest based on past performance? The answer most people will tell you is, oh no, that's terrible. So what do most people base their investment decisions on? Past performance. So money managers have accustomed to playing chase. They're too afraid to tell their clients, look, this rally is not going to hold. We should stay in our position. But no, people are impatient. They will move their money if they don't see it going the same direction as the market. Even if the money manager knows that they're going to be caught in the wrong positions when the market sells off, they have no choice. They will do it. They just what happens. So yes, everybody gets to play chase. Next question regarding QE is deflationary. Would it be possible that the Feds notice extraordinary situations that can cause deflation, panic, and introduce QE to preemptively starve off deflation? All right, so first part of that question is you're assuming the Fed can actually see things before they happen. They don't. They use lagging data. They wait for their lagging data to confirm further lagging data. And just in case, they wait just a little bit longer to make sure the lagging data, the confirmed lagging data, confirms the current lagged data, and then they react. The Fed does not preemptively do anything. That's not in their playbook. It's relatively easier for the Fed to get out of an inflationary environment than a deflationary spiral. Well, look, the Fed can put out an inflationary fire faster than I can kill a fly buzzing around this room. I mean, they could do that in a blink, and it's super easy. They could just dump their whole bond portfolio back onto the market. They could jack interest rates up to astronomical levels, and they could kill inflation super fast. Now, they crash the economy doing it. What do you mean they crash economy? Look, if the Fed put the federal funds rate at 10%, would you keep your money in the market, or would you go deposit it in a money market account earning 10%? I bet you'd go put it in the money market at 10%. And as people shifted out of that, you get massive deflation. They crash the market. So yes, they cannot get out of deflationary spiral. Why is that? Because the Fed does not have the tools, mechanisms, or ability to create inflation at all. All they can do is raise and lower the federal funds rate and raise and lower the monetary base through quantitative easing. And when they do quantitative easing and lower rates, they actually create deflation in the hopes to get rates low enough to cause inflation. So no, the Fed can't actually deal with deflation either. Deflation is the worst thing for them because they know they can't deal with it. That's why Powell made that statement today that we could get into a solvency problem, because he knows he can't deal. There's nothing he can do. So forecasting deflation, they get borrowing real cheap by the time deflation arrives. No, see, that's wrong, because what happens is they are the ones who create it. You've seen the charts, right? Yields go down, oil goes down, and CPI goes down, PPI goes down, and bam, you've got deflation. No, it's the Fed that causes all of this. And so, by the time deflation arrives and makes it plateau, then they easily manage ensuing inflation in a debt-based economy. Nope, doesn't work that way. I mean, it would be cool for the Fed if they could manage deflation, but they can't. They do not have the tools to. You understand, when the Fed was created, deflation wasn't an issue. The issue was just inflation. So they didn't give the Fed the tools to create inflation, because at the time, and the still belief is today, is that's not an issue. We should not have deflation. Inflation is the fear. Regarding negative yields, considering real yields are going up, yes, we do. We saw it today. Due to deflation, 3-month, 10-year set would go through a price adjustment causing negative yields. Would the Fed have to increase rates or taper off QE to maintain a positive yield? Well, no, the Fed doesn't want a positive. Well, the question is a positive yield, do you mean by positive real yield or positive interest rate? Well, the Fed doesn't really care. The Fed does not want positive real yields. They want negative real yields, and their only solution now is to lower interest rates. Technically, they ought to raise them to create inflation, but they won't do that. They will never do that until they have to do it. So the natural course for them is to keep lowering rates, continue to deflating the economy until they crash the whole thing. That's what they will do. It's what they've always done, and there's no chance that they will do anything different. If these bonds China holds do get sold, are they likely to end up being bought by the Fed? Is the flow of these Chinese-owned bonds to the open market, then the primary dealer banks, then the Fed? Yes. So yeah, if China was to start selling, they go to the open market. We'd assume that that's where the primary dealer banks would buy them, and then the Fed could come in and do quantitative easing. Technically, the Fed does have the ability to go out and buy an unlimited amount of U.S. Treasury debt and mortgage-backed securities at any time. Would they route it through the banks? Probably, because China is not going to say, hey, you know, we've got $1 trillion worth of your debt and tomorrow we have zero. They're not going to do that because that just would create domestic inflation. They don't want that. I don't buy that China is going to dump their Treasury bonds at all, because think about this from a world liquidity cycle. If they're not buying our debt, we're not sending money over. That they're an exporting nation. I don't think that happened, but in the end of the day, you've got it correct. So it would go from the open market to the dealers, probably to the Fed. Love your video, Stephen. Been watching for about 2 months now. Cool. Glad to have you here. I'm a younger guy that just got out of the military. Hey, you know, I want to thank you for your service. In fact, not only you, but our other active members watching, our veterans, thank you for your service. I know you make a big sacrifice. I know your families make a big sacrifice. And you did that to keep our country safe. And I just want to thank you from the bottom of my heart, my family's heart. You know, my father's a veteran, and we do appreciate your service. So thank you very much. And I'm very happy to have you as part of the channel. So got out of the military about a year ago and back in school. Hey, you know, let's finish this sentence up. Good job on going back to school. Look at this right now, folks. If you look at who's losing their job, it's people that don't have a college degree. Now, it doesn't mean if you have a college degree, you're immune, but look who lost their job first. So good job. Keep up with that. That'll be very good. The content that you and others have made me consider getting a minor in economics or finance. I personally would not waste my money getting a minor in economics unless you were going into some economic related field. I say that personally because I took classes in college related to economics. I didn't think they were that great. And in fact, I think, and I can only say this because I think my actual channel is much better at economics in real time than anything you're going to get out of a college textbook. But unless you're going into economics, I personally probably wouldn't waste my time. And I'll tell you what, though, one of the best classes I ever took, I recommend to anybody in college, if you have this class at your school, take a class in basic contract law. And I guarantee you, at some point in your life, either you, someone you know, someone you love will have a contract issue come up, and you'll at least give them some peace of mind when you tell them how contract law works. I think that's one of the best classes I ever took. My dad, who's listening, he knows, yep, that was a really good class. Not that I've ever been sued, but when you buy a car, it's a contract. You buy a home, it's a contract. You need to know what your, where you stand, where they stand, what's legal, what's not. It's very, very helpful class. I could think of other things to get minors in. If I went back to school, I could think of, I would not get a minor or a major in economics or finance, me personally, but I'm very happy to hear you're going back to school. Keep us updated, and we'd like to share in your success as well. I have a question regarding your thesis. At what time frame are you expecting to play out in several months from now? It looks like there really needs to be another breaking point for yields and interest rate to fluctuate significantly. Yeah, we got that this week. I mean, that was the CPI and the PPI. So we really got everything we needed right there. And I don't see that happening in the near future in 1 to 2 months. I do. Also, how do you regard the Newswire? I don't. In fact, I actually had to cancel my cable because I was too tempted to turn on one of the major financial channels at night when I got home. And I do not listen to major news, financial news. I do not look at it online. I do not go to any of those sites. Follow-up from that is, what places do you recommend getting your news from? Thanks so much for your content. You're very welcome. I actually look at just the economic data. I subscribe to Rosenberg Research, which is written by Dave Rosenberg and his team. Guy is one of the top economists in this country. It's not cheap, so it's not something most people would even consider paying for. And I read him because he breaks down the economic data deeper than I have time to go through. But I literally look at the economic data on a daily basis, look at the markets, look at my charts, and try to teach myself how it works. So I honestly don't really rely on too many other people. I used to do that, and I found out it was better if I don't. I know that's not the answer you're looking for, but that's the truth for what I do. And last question, because the one after that we'll save for Friday. It's a bit longer question. Hello, Steve. I really appreciate your videos. Great, thank you. Been learning a lot from them. I hope your channel continues to grow. So do I. How will launch a 20-year bond affect TLT? It won't. I looked up the prospectus of TLT, and they don't buy 20-year treasuries. iShares actually has a 10 to 20-year treasury bond ETF, and it would be the one buying, so it shouldn't have any effect on TLT. So anyways, thanks for watching. Celebrate, we won, we did it, we nailed it, and I'll see you on Friday for the deeper weekly economic update where we dig into the credit data and find out who has been buying bonds. Maybe the banks have been buying more, I don't know, but I'm pretty excited. Everything's playing out just as I hoped it would. I'm Steve Van Meter. Thanks for watching. Bye now. The content of this video is provided as education and information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation of buy or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steve Van Meter, own personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steve Van Meter Financial.